You're right. Like, we've made a mistake where we moved into a market and hired a bunch of people, and then we're like, okay, now it's time to start marketing. We didn't have leads, right? The phone wasn't ringing. These guys are sitting on their ass. And so there's a real strategy of, okay, when do you turn on that flow? When do you start advertising? Is it a month before? Is it 2 months before?
Welcome to The Boost, a podcast for home service contractors. We explore leaders and innovators in home services, their personal journeys, thoughts, and experiences with growth, marketing, and succession. We cover the good, the bad, the ugly, and its ultimate impact. Hello, everybody. Thanks for being here. Welcome to another episode of The Boost. I'm Zach Wilson, Chief Marketing Officer of Local. Today, we have Ben Hummel, Vice President of Business Development at Legacy Service Partners. Ben, welcome. Thanks. We made it. Ben and I had a tumultuous, that's probably too strong of a word.
Between airports and car drives, we definitely had to reschedule a couple times. So thanks for your flexibility and excited to be here, Zach.
Let's just dive into it. What is Ben's role and what is Legacy Service Partners?
Legacy Service Partners, or LSP for short. We're a home services platform. We invest in HVAC, plumbing, and electrical contractors across the country. We've got about 32 partners currently on the platform and about 550 million in top line revenue. So pretty significant operation. We made our first investment back in June of 21. So we've scaled pretty rapidly since then. And I've been with the business for about 2 years, but I've known Rob, our CEO, longer than that. We actually worked together in a different life in video games. But my role at Legacy has been actually pretty varied, which is one of the things that I love about this company is that it is a startup in a lot of ways, but then at the same time got a pretty significant operation. But I was hired as a regional vice president overseeing a portfolio of businesses on the West Coast. I actually then stepped into a GM role for about 6 months. One of our businesses is an interim GM that was managing through a transition of leadership before we could hire a full-time person. That was incredibly helpful for me to understand the day-to-day struggle and grind of our contractors, what they're contending with from a customer interaction, employee standpoint, vendor, all of the nuts and bolts of the daily operations. Coming out of that, I took over our corporate development function. So I was managing all the vendor relationships that we have. Obviously, given our scale, we hope to negotiate with HVAC manufacturers or plumbing manufacturers, as well as consumer finance. Any pick a line item on the P&L, we try and go out and negotiate from the LSP perspective to drive down those cost savings back into all of our businesses. Since January, have I really taken over the business development function, which is focused on M&A. Yeah, so it's a relatively new role for me, but it's been really exciting. And, we've got really lofty targets and we're well on our way to achieving those. And, we'll hope to grow quite significantly every year through mergers and acquisitions. So that's me in a nutshell at Legacy. I've been here for about 2 years.
That's a great introduction. An interesting point for me is gaming. Is that on the business side or the recreational side? You guys were hobbyists and met through some sort of network.
I guess both. We ended up playing quite a bit together too. Rob was the chief of staff to the CEO of a video game company called Activision Blizzard. He was the CEO's chief of staff. He hired me to replace him actually. And then he founded Legacy and then I kind of followed over after.
Legacy's only been around since 2021?
Yeah, June of 21 is when we made our first partnership.
Where does the backing for Legacy come from?
Originally, 3 co-founders, Jake, Frank, and Rob, our CEO. Jake and Frank are just incredible investors, and they've actually done a few roll-ups in the past. They started with a veterinary clinic roll-up, and they moved to a commercial HVAC roll-up.
I heard about this, actually. Which one specifically is doing the commercial roll-up now?
That one's called Crete United. And
who's the founding partner that's moved over to that? Sorry, that's what I meant to say.
Yeah, so Jake and Frank were the co-founders of both of those roll-ups, as well as Legacy. We're actually not really related. I'm not sure who's the CEO of that. Jake and Frank's model is to tap sort of an operating co-founder, right? Legacy was able to kind of ride the coattails of the success of those previous 2 roll-ups to raise a pretty significant search fund with friends and family, money. And then we took an investment in January of 23 from Gridiron, which is a private equity company out of New Canaan, Connecticut. They're a premier investor in the home services space. They have a few other incredibly successful investments in roofing and gutter protection, but nothing changed when we took the investment from Gridiron besides our access to capital. They're really helpful partners from a higher level perspective, particularly around maybe some of our technology stack, but the problems and the issues and the challenges that we solve ourselves. I mean, it's Rob, the management team. There's been no change since the partnership with Gridiron. Yes, we're a private equity backed roll up, but we're also first and foremost building the best home services business, and the team that's been doing it since day one is the same team that's doing it now.
Gotcha. I was curious about Crete because just coincidentally, right after I met you, I went to Florida for another conference and met basically the mirror image of you on the Crete side. We just sat at the bar all night and gave me the whole spiel, and I was putting the pieces together. And at that time, I was like, holy cow, I met your twin a day ago on the legacy side. And he was telling me the whole story. And I was just like, this is wild. I'm so interested in this. Anyway, that was a weird coincidence. To frame the question in the eyes of the viewers, now if I'm an owner operator in HVAC specifically, and I'm in the market looking for some sort of succession transition, and I'm looking at this as one of my possibilities, what do you guys bring to the table? Why should I, as the owner, talk to you guys, consider you guys, and think of you as part of my succession planning or succession in general? LSP, that is, of course.
I'll start high level and then kind of dial into a little bit of what Legacy thinks about when we partner with somebody and the ways that we support the operations of the businesses that we do partner with. So I think it's important to note that there's many different models out there when it comes to succession planning or transacting your business. There's shops out there, quote unquote, competitors of ours that will come in and they will buy 100% stake in your business. That's the right fit for a lot of people. If you're an owner operator who has been doing this for a long time and you're saying, I've had a great run, like I just don't want to really be thinking about this business anymore, right? And I'm ready to go play golf and enjoy the fruits of my success, right? Recognize all of that there's folks out there who will come in and buy 100%, and then your role in the business really goes away. And there's other models similar to ours where we want our owner operators to be thinking about the next 3 to 5 years, maybe even 10 if they've got that runway, and really knowing that they can grow, really knowing that they've built a great business. There's a few things that they want to tackle that having a strategic partner would just make things a lot easier. And they want to continue to own and operate the business that they built, right? So in our model, in Legacy's model, we typically take a 70% stake in the business.
That's your minimum. Is that what you're saying?
That's just typical. So we're very flexible when it comes to what that right number is, because each owner operator is going to have a different perspective on what they want, whether they prefer less ownership, more upfront cash, more ownership, which means less upfront cash, but much significant rewards on the second transaction, which we'll get into in a little bit.
Gotcha. Okay.
That number is very flexible. Typically, I think 70-30 is a good split, but we've had 60-40 relationships. We've had 80-20 relationships.
I guess just for clarification, safe to assume the bare minimum would be 51%.
I think realistically, the floor probably is 60%.
Not much difference there.
We're going to be the majority owners. In our model, when we partner with somebody, the owner rolls their equity, whatever that remaining stake is, let's just say 30% in this scenario. They roll that equity directly back into the business. And that's a pretty important distinguishing factor. And it can be a little bit nuanced, but in some models, when you roll equity, when a sponsor, PE-backed sponsor says, you roll equity, sometimes they give you shares in the broader business, in the holding company. And so you become a very, very, very small slice of a much larger pot.
The 500 million in this case.
The 500 million, right? Yeah.
Right.
In our model, you retain equity directly over your business. So in the operating business, let's say, Joe's Plumbing in Florida. We take a 70% stake. Joe is still a 30% owner. His equity resides directly in his operating business. And our core philosophy is we don't want to come in and change your brand. We don't want to change your culture. We don't want to be the ones that are shifting away from a strategy that has built a great business. And we rely in a big way on those owner operators to continue to execute on their local plan. Now, what we can do is really support from the back end. You can come in and we'll get you onto all of our technology systems, which include Service Titan. I think we're the third largest Service Titan account or something like that. We can get you onto our human capital management payroll system, get you onto our finance ERP system. Those things really are the kind of only mandatory changes, because that way we can really be super effective supporting you from our back office here in Tampa. We can take off all of your accounting. There's still going to be a need for a local accounting resource, but AP, we can run it all centrally here in Tampa, right?
Especially with the streamlined back office, because everybody's reporting and everything just funnels.
Closing your books, all of that financing stuff.
All those processes are there.
And we can hire the best people for that one piece of technology, as opposed to having to contend with 4 or 5 different systems. From a back office perspective, we've also got marketing support, we've got HR support, we've got legal, finance, accounting, right? All of those back office functions we can really take a lot of that burden off of the owner operator so that they can focus on the fun part, which is growing the business, the operations, right? You have operational support as well. And it comes in the form of kind of two different ways. We've got a layer of support or management called a regional vice president. And that's actually the role that I was originally hired for 2 years ago. The regional vice president or RVP, they oversee a portfolio of 6 to 7 businesses. Really, they're the strategic partner for the owner operators as they think through their plans. Okay, it's 2025. What do I want to get done? I want to add a service line. I want to expand into a new geography. I want to overhaul my call center and get my conversion rate up. It's like, working together with the RVP and the owner, they come up with these strategic plans. And the RVP is the one who's helping those owners really make sure that we're making progress towards those stated goals. And the other big thing is connecting the dots between our network of owner operators. I think one of the strongest things about Legacy is the fact that we've got 30 plus owners who are still deeply invested in their businesses, who have collectively hundreds of years of trades experience. We've built this really incredible network, right? And oftentimes at all stages of where our businesses are, we're pretty size agnostic, right? So we've got businesses that are doing $1.5 million of income, and we've got businesses doing $10 million of income. That's $8 million of top line versus $60 million of top line, right? So there's a huge spectrum in the businesses that we've partnered with. And so that means somewhere on our platform is an owner who's been in the same shoes.
That's super interesting. That's super valuable. In the interest, again, of the audience, what's the floor or cutoff for you all in terms of who you're even going to be talking to?
I think first and foremost, I would say the most important thing for us is the owner operator themselves. We have a hard and fast rule. We won't do a deal with anybody until we've met them in person. I've got to be there. I've got to look them in the eyes. I've got to feel that they're going to participate in the network, right? And benefit from it. So I don't want to put out a number and anchor somebody. Maybe the generic answer is probably $1 million of EBITDA is kind of like the floor. But we've gone lower than that. We've looked at partnering with folks who are smaller because we believe that, hey, this guy or gal is such an excellent operator. There's a lot of runway. And look, it's a lot easier to grow a business from 4 or 5 million of top line revenue to 10 than it is a $60 million business to 65.
I would agree with that for sure, especially the way that these businesses are structured because of all the local efficiencies and inefficiencies that just exist or may not exist. We can talk about that a little bit in terms of these strategies. Some of these larger operations trying to jump markets that are 200 miles away. I'm in Southern Ohio and Cincinnati, and there's a couple that have come from Indy, Columbus, Cleveland. That is a hard jump. We're a regional market. We're not a big city, New York or whatever. There's a lot of competition here. And to jump markets like that, and you've got to spend some boku cash on the marketing side to just make a little bit of dent. I know one of them, can't remember who the owner is now, but one of them does pretty well here, but there's a couple new ones. And I'm just like, man, I do not want to be in your shoes in a couple years because it's so crowded already. And again, these are big companies. They're probably like 30 to 50 million top line revenue. So it's like to make that jump and see significant lift, it's got to be significant. You can't come in and make a few $100,000. I don't know if you want to speak to that or talk to that in terms of your regional vice presidents and those strategies and how they've played out or whatever.
I talk to a lot of single trade contract. They're a great HVAC shop or a great plumbing shop. They've reached a stage where they're thinking about adding additional service lines. We've got this great warehouse. We've got these processes. We're doing really well with this trade. We're walking into all of these consumers' homes, these customers' homes, while we're looking at their HVAC system. By the way, we're seeing their water heater. They ask, hey, do we do plumbing? We love your 5-star service when it comes to HVAC, and you recommend a plumber. Wow, I'm leaving all of this opportunity on the table. You think it would be like, oh, well, let's just hire a couple plumbers and get going. It's a very different animal. I think that having somebody who's done it before is a really incredible resource, right? To be able to pick up the phone and call either your RVP, who's probably launched a service line at one of their other businesses, but more importantly, call Brian Enders at HL Bohm, who launched plumbing and grew it to $10 million in a couple of years, right? Like, how did you do this? What were the mistakes that you made so I don't make them? Can you send me your price book? Right? So I don't have to spend all this time thinking about plumbing price book with services and job types and all of the minutia of setting that up. So can we just port that directly in from your service type environment? There's a huge efficiency gain. You can say, hey, I have this great plumbing manager. He needs a little bit of polishing. He needs a little bit of help. He needs to see what a real shop looks like. Can he come up and embed in your business for a couple weeks or a week or two? And all of the guys are motivated. In our model, because you own your own business, you're going to be rewarded based off of your own business, right? But it's also rising tide. We're all together in this. If we all do well, everybody's going to do well. So there's a very open willingness to engage and share the knowledge. And it's a really, really incredible part of the platform.
I mean, are there examples out there? And what did you say? You have 30 different brands?
Yeah. 32 operating brands right now.
There are examples of adding services or adding markets where they just don't go as swimmingly on paper as they should go.
I think it would be foolish for me to say that we haven't made mistakes, right? And we haven't had a lot of learnings.
I got to be honest. I think that a lot of people think that this is just a copy and paste and you get on board and you milk the cow and you produce milk. I honestly believe that most people are out there and get to my 1 million EBITDA, I get to my 10 million top line, whatever. And then I sell and all of a sudden I've created some significant wealth. It's funny because I think that the marketplace in general is set up, or the economy is probably a better way to say it, of this stuff is set up in such a way, and it's by design, right? Like we all want to believe that is how it goes because that's marketing, right? Like it's your job to make it look like this is no slight on anyone. There is a reality that, for every one that hits, there's 10 other ones that are just fine or they don't burst or whatever, right? So that's just a reality. For every Facebook, there's 10 million others that have tried timing, the market, the just serendipity and the sequence of events, and it just doesn't happen. As consumers, we're led to believe that, it's so easy, but these glory days are great and so on and so forth. Yeah, I mean, I think that's just interesting to hear just that from the true insider perspective.
To back up a little bit, when you were talking about geographic expansion and taking a brand into a city that might be 200, 300, 400 miles away, right? We tried something similar with one of our brands, didn't work out. The approach that we now do, what we call greenfielding, which we've done with quite a bit of success, is rather than try and jump some mid-market to mid-market, there's all of these little needs in towns where if you've got a big brand or even a medium-sized brand, you don't need to go find the next big population center. Find the town of 20, 30, 40,000 people that is 60 miles away. Probably not efficient from a drive time perspective. You don't service them now because you don't want your technicians with 2 hours of windshield time that's dead space that you're paying for, right? But what if you could hire a single technician in that space? What if you could hire a couple of technicians, right? You don't need a full office there. Go get maybe one office, little space, right? But maybe a storage unit for some parts and pieces. You run all of the back office out of your main shop, right? You keep your call center there. You keep all of your managers there. That's where you still have the main warehouse, right? But then you're saying, okay, if I'm in Harrisburg, Pennsylvania, well, Westchester is about an hour away. Town of 60, 70,000 people, right? Let's go dominate that market. We don't have to double up all of our overhead costs. We keep our overhead costs the same, but we hire a technician who's based out there. Or the way we think about it is you do need kind of like a mini GM or an operations manager of that town. You need somebody accountable for that town, right? Somebody who's saying, I am responsible for everything that's happening in Westchester or Reading or Lane, whatever it is. It also proves to be a really great training ground for management that's not maybe quite ready to take on a real role at the main shop, but is almost there. But let's give this guy a shot. Let's give this gal an opportunity to step up a little bit in a way that they can really feel like they have a sense of ownership over the growth of an expansion. That's how we've kind of done it. We've taken our base brand and moved into a shop maybe 50, 60 miles away. Then you build density throughout that, start to hear about you start to see the trucks, right? It's kind of this organic development of expansion. And you're right, we've made a mistake where we moved into a market and hired a bunch of people. And then we're like, okay, now it's time to start marketing. We didn't have leads, right? The phone wasn't ringing. These guys are sitting on their ass. And so there's a real strategy of, okay, when do you turn on that flow? When do you start advertising? Is it a month before? Is it 2 months before? That's secret sauce that I'm not at liberty to share, but we figure that out. We know when to do that. We know when to start because we've done it now, 12 times. That's some of the ways that we can support.
With the operational efficiencies and the capital efficiencies that someone like you has that you can absorb, it makes it much more digestible in general. So, yeah.
Oh, particularly from an owner's standpoint, right? We're essentially, Legacy is your strategic partner in investment, right? We're spending 70% of the cash to do this, right? And de-risks the sort of entrepreneurialism of a lot of our owners who are saying, hey, I've wanted to take this risk. I've wanted to jump. I've wanted to take this initiative, but the capital is expensive. I don't want to tie up a bunch of my cash flow into this initiative, even though there might be really great rewards. It can be a really daunting thing for a single owner operator to try and do. Well, now you've got a strategic partner who's paying for 70% of it. You can really do a lot more with that. Oh, by the way, I've saved a whole bunch of money on the back office because all of my systems are more efficient. All of my processes are more efficient. I'm saving 30-40% on my equipment costs because we at Legacy go and negotiate directly with the OEMs and get you a 26% rebate.
In talking about that, and a sort of gentle segue here is talking about your pipeline and delving into your process from the owner's perspective. And I don't know whether it's a law of averages, but for every 50 you talk to, you end up one deal or whatever. I don't know if that really matters actually. But more importantly, once you find somebody that you're interested in, Joe's Plumbing in Tampa or whatever your example was, what does that engagement look like from start to finish? When do you guys get your LOI and start actually delving into matters? Again, law of averages generally take for LSP to come in and get to the finish line, if you will.
We aim to close, once we've got an LOI signed, we aim to close the deal in 45 days. It's very contingent on the receptiveness of the owner operator. How quickly are we getting data back? How quickly are we hopping on calls? And I'm not going to sugarcoat it. Like, the diligence process can be intense. It does take time from an owner as we bring in third parties, review the legal side, to review the financial side, right? Doing a Q of E to tie out the cash proof. That is not a super light process, but it's also millions and millions of dollars that are on the tables. Typically, owners are pretty motivated to be receptive because that's the payday. Typically, we close in about 45 days after the LOI, but really, the pre-process LOI, I think there's such variability out there in how prepared folks are for a sale. Obviously, if you're working with a banker, there's a lot of bankers in the space. So if you're working with a sell-side banker, typically that banker will do a lot of the prep work for you when it comes to preparing your financials and factoring in what your add backs are. And they typically run a very strict process where they go to market, they say, hey, this is the business, we're soliciting IOIs, and then you have a meeting after the IOI virtually, and then you have in-person meetings. That can be a pretty extended process. But if you're out there, you're an independent, you haven't thought about working with a banker, I think there's a lot of work you can do up front to prepare yourself for a sale. I think that you should be thinking about how to really get a hold on your financial performance, definitely for the year prior, but ideally for what we call the TTM, or trailing 12 months, which would be the year immediately prior or previous to when we have the conversation. And if you can have a real sharp accounting and knowledge of what is an actual business expense and making sure all of the actual business expenses are in there, and then what are personal expenses? Because look, there's a lot of personal expenses that flow through these businesses, and that's totally okay, right? We know that there's oftentimes those two things can get intermingled, personal and the professional, and that's totally fine from our perspective. What we need, though, is for that owner operator to have a very sharp accounting of, okay, this line item on the P&L includes 50,000 of my personal credit card expenses, and I've got the receipts to sort of back that up. And so if folks have done that already, then it's a very quick process. We can get to an LOI in 2-3 weeks. Like, you'd mentioned that at the top that I'm traveling a lot, and it's true. I need to be in person and see somebody, right? And if there's chemistry and there feels like there's a lot of good synergies and they're excited about it, we can move from the first time we get financials or the first conversation, we can move in a week to get an LOI signed. I will be anywhere at any time because it's so important.
In the interest of that, and I think this is probably true, as you go downstream in the smaller businesses, again, top line revenue, 5 to 10 million, maybe whatever that is. I mean, you can probably get into some situations where you're like, this data is just like worthless, right? Some of these businesses, no joke, we were talking to someone that had to convince, it was family succession, but literally had to convince their father to go from paper to digital. Everybody is not on Service Titan running with optimal platform of KPIs where every tech can see their performance and stuff like that. There's still a lot of businesses out there that are pretty lo-fi. So how do you handle those? Is it just like a feels good type of thing?
I mean, typically most folks are at least on QuickBooks.
Okay, fair.
And so I've also seen tax returns. There's a little bit of art to the sign, particularly with the smaller ones. What is the scope of the opportunity and how can we add a value to that if we don't have a real level of confidence in the actual financials? We can say, hey, look, we like the market, right? We like the owner operator. We think with a little bit of rigor, right? They've got 15,000 customers in their database, or maybe they've got 15,000 paper invoices or contracts, right? You hire a temp for, and that person spends all day, every day for 3 weeks uploading them into Service Titan, manually doing that. We've done that before. We partnered with a business that was all paper, and it's this incredible operation that that needed a lot of support moving over to Service Titan. And that was the reason why he partnered with us, right? Is because he was saying, hey, this is a huge endeavor. I don't think I can take on by myself. But with a strategic partner who's done this before, I can do this a lot more efficiently. There's ways we can get to the number, but I've seen quite a few very interesting accounting methods for sure.
I can't say that I'm surprised. I think we meant to touch on this earlier, but skipped over it or glossed over it. The general state of the market from where it was, right, to where it is, just in broad terms, what was the highest multiple that you saw across the table versus, again, talking law of averages in sectors, whether it's HVAC, plumbing. I actually don't know this. Is it just HVAC, plumbing? Do you do any roofing? No.
We don't do any roofing or windows or doors or solar. We do electrical and drains and sewer as well. We've got quite a few large electrical contractors.
Oh, okay. So more or less those three minus the niches that exist in plumbing specifically. However you want to break those down, I think people are generally interested in what the change in landscape is, where things were to where they are now, or where you think they're going, especially with interest rates and election year and all the general rhetoric that people love to talk about and influence these decisions.
Yeah. No, I mean, I think a lot to unpack. And
talk in broad terms.
The things you mentioned are real. I think we're seeing it. Q1 was pretty soft for a lot of people. And yes, the weather played a part of that. It was a weird year across the country, but also I think there's a lot of uncertainty in the economy right now. Like, supposedly inflation's coming down, but a lot of average Americans don't feel that. You're going to the grocery store and still spending what feels like way too much money on groceries or gas or rent or whatever it is. I still think we're contending a little bit with the pull forward of demand from COVID. There's a lot of home improvement work that happened that otherwise wouldn't have happened, or at least in the timeline that it did, because of folks being stuck at home. I think we're still seeing some of that. I think there's also not a lot of people are moving right now, right? People are stuck in these zero interest loans and they're not thinking of upsizing their house. And a lot of that work, when you move into a new home, you've already spent a bunch of money. You're like, what's another 15 grand for a new HVAC system, right? So a lot of that, I think, is pushing down on demand. We saw a lot of folks have tough Q1. Now, we did great, right? Our Q1 was really strong. That's the beauty of the platform, right? Is that we have multiple folks across different geographies. So we de-risk a lot of that. So instead of being a single shop where the impact of a warm winter is going to be much more significant, right? We had businesses that were up 100% year over year. Now we had folks that were down. So that's where you smooth it out across the platform. And the reason why I mention that is that's why we as a platform are going to command such a higher multiple. Obviously the scale, we're so much larger, but when we go to transact in 3 or 5 years, we'll be looking in the 17 to 20 times range. Now for a single contractor, that multiple has been all over the place, kind of as you referenced, right? In the time of easy money and cheap, 0% interest rate, 0% Fed rate, I was seeing 11, 12x for $1 million EBITDA, which is pretty insane.
Good on those people. Congrats.
Unfortunately, I think that has permeated some of the thinking. And so now people are coming to market because their buddy went to market a couple of years ago, commanded that 10x multiple and thinking that they're going to get the same. And unfortunately, that's not where the market is right now. Interest rates are very high. I think a lot of people are having softer financials. And so I would say the range right now that we're really seeing is kind of in that 6 to 8.
Still pretty good.
But I think it's important for folks to reality check too. Like there's ways where you can actually increase that value regardless of the EBITDA that you're pulling in. If you've done a lot of work on thinking, how am I going to grow this business? Can you articulate your strategic plan? If you can have a grasp on your financials, right? Then I have a lot more comfortability paying you 8x for your business because I know that this is going to be a good partnership for everybody because I feel a lot more confidence that this business is going to grow from 1 million to 2 million in a relatively short order, which makes our investment a lot more attractive. And so I think it's important for people to know the rate is still really high. Capital is expensive. There's been downward pressure because of the uncertainty in the economy, because of the election year. I wouldn't walk into a meeting and expect a 10x anymore. If you're doing 3, 4, 5 million of EBITDA, not a ton of folks out there are doing that haven't found a partner, then maybe you start talking about the 9, 10, 11 for that scale. I think for most contractors out there, that 6 to 8 range is kind of what they should expect.
Gotcha. So as you go up in EBITDA, even though, as we mentioned earlier, your ability, generally speaking, to increase revenue and market share as you go larger, right, is more difficult because of all the things we talked about. But the interesting thing is you're generally willing to pay more for the larger companies. Why is that? I guess the better question for the listeners, what should someone be trying to do? Let's just say they do want to go from 1 to 3 or 1 to 5 in EBITDA, and that's their goal. What are the things that you, LSP, look for in terms of that path or that growth? Is it memberships, tech stack, trainings?
Yeah, I think the answer will actually address both parts of that, because the reason why we value a business that's 3 or 4 or 5 million of EBITDA typically is because they have the things that a business needs to grow to that, right? They have, and you touched on some of them. What does the management depth look like? Yes, there's a strong owner operator, but typically those businesses have a really strong HVAC service manager. They have a really strong plumbing manager. They have a really strong install manager, right? There's a layer of depth underneath that GM that kind of de-risks some of the business, right? Like the de-risks the worst case scenario that the owner gets hit by a bus the next day, right? Something, right? Like that's important. Probably harder to scale a $3 or $4 million business, but it's also a lot harder to go down, right? Because there's all of these processes in there, right? What is the management structure? EOS is a term that's used. It's an operation like term to describe what's your management cadence. Do you have weekly manager meetings where you're reviewing KPIs, right? Do you have a budget? Do you have a grasp on what you're trying to get through this month or this week? And how is management thinking about trending towards those things, right? What's your talent pipeline like? Oftentimes these bigger businesses have really great relationships with local trade schools or high schools. And so they're getting the first crack of the apple at these technicians that are coming out, right? Those are all things that, how sophisticated are they on using consumer financing, right? Some of these bigger businesses, they're doing 40% of their revenue is finance, right? And we know that if you finance a job, your average ticket's going to be higher, your close rate's going to be higher. All of these good things about using consumer financing, that typically is more built into a larger business. So all of those things we think are really important, because yes, it's easier to grow a $1 million business to 2, but there's a chance, right, that business could really fail, right? Whereas a $3, $4, $5 million business in EBITDA, the chances of that going downhill are lower because they have all of this institutional support. And we can still come in and find a lot of efficiencies with that, right? Maybe we're not saving them 40% on their equipment costs, but probably 20. And yes, we can probably alleviate some back office headcount. We can do it locally, essentially in Tampa. They've got a controller, right? And we can really sort of be a support for that person, so that instead of closing their books in 20 days, we're closing them in 8. That stuff can really increase the efficiency of a business. And that's why we pay more for a larger shop. Just because you're doing 4 million in EBITDA doesn't mean we're going to pay you 11x. You could be doing 4 million in EBITDA because you just happen to be the only operator in town. But once we click into some of the ways that they've gone to grow there, maybe it's not worth that.
I think that's a great answer. There's a couple of things out there that we mentioned in terms of the private equity, right? Or these platforms, as we like to call them. In terms of the market, there's this new, different, whatever, frontier that's coming onto my radar. And I don't know if it's yours or not, but these privately held groups that are aggregators of sort of same thing. I mean, they're holding companies, right? Or they're investing privately, but their goal is to hold on forever and just sort of build these portfolios, call it more like a sort of Berkshire model. A couple of the ones I'm aware of, I don't know if you're aware of them or not, but up in Ohio, there's one called the Wilson Companies, Hoffman Brothers Solution Group. Are you guys competing? Are they competitors? Are you competing for the same brands? Are they just two different sellers that really are looking at, like, I want to be owned by, again, Hoffman Brothers Solutions Group or the Wilson, I want to be owned by a family company and know someone that's in the trade and versus, whatever, you guys, private equity, true private equity, and whether the dollars are different or the same, are there forces out in the market that you're seeing that are just people are choosing one or the other for different reasons? Or is that just not someone that comes across your desk, if you will?
It just gets back to what we kind of initially spoke about, right? Which is, what are your motivations? What are you as an owner operator looking to get out of a transaction, right? If you partner with Legacy, you are saying to yourself, I've got maybe 5 to 10 years more of operating this business. I think I can grow this thing. I've got a lot of opportunity. I really enjoy doing this. I just need a little bit of help to do it. I just wish some of my life was a lot easier. And I think that, that is the ideal operator. We didn't really talk about it, but we as a platform ourselves looking to have a transaction similar to the way that, any business that we talk to is selling themselves. We will also sell ourselves as a platform in 3 to 5 years, right? That's kind of our timeline. And so in our model, because you own 30% of your business, when we transact, that 30% ideally should be worth much more. Well, using the numbers that we've talked about, right? Let's say
1 million EBITDA.
We valued your business at 7x. We paid you 70% of 7 million, which is, gosh, what, 5 something, right? We paid you that much upfront, but you retained 30% of your business. Now, let's say in 4 years, we sell for 20x. We're at $1 billion in revenue, 200 and something million of EBITDA, and we sell for 20x. Our multiple is 20 times. Your 30% is now worth that much, right?
Right.
Now, there's a little bit of nuance, but for the simplicity of this, like that 30%, and let's say you've grown in those 4 years, you're now doing 30 million. Let's call it 3,333,000. So 30% of that is 1 million of EBITDA. You own 1 million of the business, right? That is now worth 17 times. That 30% chunk is now worth double or triple what we initially paid you for, right?
Right.
If that's an exciting prospect, if that's what motivates an owner to say, hey, I'm going to have full entrepreneurial control over my business. I'm not partnering with somebody who's going to come in and rip out my brand or rip out my culture and tell me I have to operate in this way or sell this specific piece of equipment. Like, that's not our model. That's somebody else's model.
Right.
But if that is exciting, that's who we want to partner with. And I think that there are other models that you reference which are much more just kind of the whole, like, steady hold, right? But they're probably, to return the money up for their investors, they're probably not going to be offering you that much up front. There might be some longer term incentive.
I would agree with that. And general theme through the podcast in general is
there's a lot of models. There's a lot of
models, and there's a lot of ways all the owners think about them. And some people, they just want different things. I met a guy in St. Louis market, right across the street from Hoffman, that is 3rd or 4th generation. He, like, part of his agreement is he can't sell it for 10 years, whether he wants to or not. I think their philosophy is, like, become the owner, full majority owner from your dad or whomever. You're going to want to actually pass this down to your children. You've grown to appreciate this is a family business and you're 4th generation and da-da-da-da-da.
And your last name's on the wall. You got framed pictures of your grandpa in a truck rolling out, and fixing a boiler.
Yeah.
We see that sort of family succession type of planning is really great in our model. We've got a few 3 or 4 father-son combinations where the father is probably a little bit, maybe he's saying, I've got a year or 2 left, but my son is ready to pick it up. He's been in the business for 10, 15 years. Like, I want to sort of do this transaction as a way for him to step up, own the business. Maybe the sort of cash up front's going to the dad, but I'm giving my son that 30% role. There's that generational wealth. When we transact, the son is benefiting from that upside. Not to sound, hyping up our model, but in our transaction structure, right? Like, there's a lot of flexibility. So when we sell, baked into all of our purchase agreements, they'll have the option to transact with us and they could sell all of their equity if they're saying, all right, I'm done, or they could continue to roll that forward into the next equity. And the guy who's 35, the son could say, I've got another 10 years, let's keep rocking and rolling.
Last sort of big question is, I think you might have mentioned it, I didn't pick it up clearly. What is the general hold time for you guys?
It's a little tough to say because who knows where the world is going to be like.
There are some platform goals. We only want to hold this for 3 years, and of course market circumstances dictate what that actually is. But
right, I think based off of our stated budget and goals, the realistic timeline is about 3 to 5 years. Based off of what we target ourselves from an inorganic growth standpoint, how much are we going to buy every year? And our organic growth goals, how much are we going to grow the base businesses? I think that gets us to the range where we want to thinking about going to market ourselves in the sort of 3 to 5 year time frame. But again, who knows? The world is a crazy place. Could something happen to accelerate that? Maybe.
Right.
Or decelerate, right? Sure. Right? I think that 3 to 5 years.
Have there been deboardings or any transactions of the original sort of portfolio yet, or no?
There have been a few folks on the platform who, when we initially partnered with them, circumstances changed, right? Whether or not they had a personal event or illness or something like that, where the original goal for them, which was to continue operating, continue to operate their business, just shifted, right? We take each of those as a one-off instance. Our partnership only works when we've got engaged and happy owners, right, who are operating their business. And so we've had a few instances where we've purchased the remaining equity stake from those owner operators because of something shifted in their life. We don't really have a formulaic way of going about and doing that. It's not like we're putting in a contract somewhere, you're guaranteed this amount of money should you sell. I would say that given that our model is so contingent on owner operators being happy and being in the model, right, it's in our best interest to also make sure everybody's feeling and talking about us in a way that they're happy. The worst thing we could do is piss off one of our owners who's connected, right, and goes out and tells everybody, hey, don't sell them because they screwed me, right? Like that would be so detrimental. So in those instances, I'm not going to say numbers, but their equity increased in value. Was it the full upside of what they could have gotten had they held? It wasn't something that they were walking away upset about.
Right. And just in general, correct me if I'm wrong, but I imagine that the general process is life event, trigger, whatever, something happens, and then I assume third-party evaluation to value the business.
At that point, we don't even need a third-party valuation, right? Because we have their financials, right? Typically, we've been the one reporting on their financials for the time period, and but the same logic we'd applied for initial valuation. Hey, look, we bought it at when it was doing $1 million in EBITDA, we valued it at 7x. It's now doing 2, right? We valued it at a higher one, right? So that 30%, right? Whatever it is, we have to be fair and good in that valuation because otherwise, you have a bunch of pissed off guys running around.
If you're in the industry, home services, HVAC, plumbing, electrical, that's just a smart branding. And we probably both are learning this and know this, is that as big as the market is, it's pretty small.
It's a small world too.
A lot of people know a lot of people, and not everybody knows everybody, but it's a pretty tight community. Last thing is just generally speaking, if you're giving some unsolicited advice to an owner looking to create a succession or exit their business, what could they do today to start the process or to help the health of their business to make it as appealing or marketable as possible to a prospective buyer? Two of the most important things that they can do to dot their I's and cross their T's. One of them you mentioned, which I didn't go into that much, but you just mentioned they were engaged some sort of sell side banker or broker or whatever. Is that step one, or do they talk to their lawyer, or do they just email Ben? That's probably a great start.
Email Ben at legacyservicepartners.com.
Number one.
Don't talk to anybody else.
Now for the real advice.
Now for the real advice. So yeah, I mean, talking to your lawyer is important, right? Getting counsel. You're going to need a lawyer when you go through a transaction, like somebody to review the transaction documents. It's important to be represented. And I think that most folks have one, but if you don't, think about that.
Let me just interject on that point, because not everybody has a lawyer. What type of lawyer, what vertical of lawyer are you working with here? A transaction lawyer, a family lawyer? Like, what are the lawyers that are best suited for such processes and deals?
We've seen both, where somebody will hire a very specific transaction lawyer, right? It's all about business law, and somebody who's reviewing, a purchase agreement or an LLC agreement, right? With all of these business-focused law things. We've also had family planning and estate lawyers do that same type of work. It just depends on the level of comfortability. Our documents are not, they're meant to be very advantageous for the owner operator with a lot of flexibility built in. We don't want to have any gotchas in there, right? Which is sometimes could be the case with some of this, very business focused law. Most folks probably, particularly if they're larger, maybe have a family estate lawyer or family planning lawyer. That's probably good enough. And I would say if you have that person, if they don't feel comfortable representing, knows somebody who does, right? So that would be the pathway. But you talked about it a little bit. I think that a lot of these businesses have personal expenses running through the P&L. And that's okay. We recognize that. But the more that you can do as an owner operator to unwind those two things, the better. It can be a little bit counterintuitive because you're thinking my cell phone bill, my medical insurance, or my wife's medical insurance, or I'm paying my niece, $80,000 a year. She doesn't really do anything, but we've seen that, right? But every dollar to your bottom line is worth 8, right? If you think about it that way, right? Because we will pay you 8 times for every dollar that you earn. And so by unwinding some of these things, you're directly increasing the value. And a lot of folks come come to us and say, well, these are all add backs. Maybe they are. If you've got really sharp accounting of all of the things that are really not truly business expenses, if you can prove of the 400 grand Amex bill, 200 of that was all personal expenses. You bought bricks for your outhouse. If you can prove that, we can get a lot more comfortable with that. But then at the same time, if we're seeing a business that's saying that they have $1 million in EBITDA, but 600,000 of that are add backs, that just is a little nerve wracking. So I think some real permanent advice for an owner operator is to at least get a very good grasp of what is business, what is personal, what would be considered an add back. And then ideally start the process of unwinding those things, of taking those off, that personal credit card off, that person who's on payroll to get health benefits, but it's not doing anything, take that person off, right? If you're running your golf membership or whatever through the P&L, or you've got your boat on the P&L, like some of those off gives us confidence that the business is the business, right?
I can only imagine how hairy that gets. I was going to ask what the most common one was, and my bet is probably the boat.
Boat and the golf membership, for sure.
The golf membership is another common one. The boat would not surprise me as being the number one. We met at the golf outing, and as we know, there's not as many home service golfers out there as there are of other industries. I do think that's great advice, and honestly, that's just being smart in terms of like how you're operating business. Try not to be cagey. Try and run your books true, as if you're not trying to get over on the IRS as we all kind of want to. But
if you think about what that value, you might be thinking you're saving, $20, $30, $40,000 in taxes or in personal expenses, right. But really what you're giving up is, 40,000 times 8, right? 320,000 in value, right? So think about it that way, it can be a little bit easier.
I hear you. Awesome, man. It was great to finally get you on. Thank you for your time. And I know because of our original conversation that you're not a big social media guy. So I usually ask where people can find you, and I will cut to the chase, and you can't find Ben anywhere.
Not on Instagram. Not on Instagram. You can find me on LinkedIn. I'm on LinkedIn.
That does make sense for a guy in your industry. So,
but yeah, feel free to send me an email.
Ben at legacyservicepartners.com, correct?
Yeah, and at legacyservicepartners.com. Pretty easy.
Yeah, I'll put that in the show notes. Cool. Well, great. Thanks again. And everybody, I hope you learned something from this, and Ben, and go get them.